Imagine stepping into a world where fortunes are made and lost in the blink of an eye, where the potential for reward is matched only by the risk of ruin. Welcome to the high-stakes game of options trading, a realm where knowledge is not just power, it's survival. Did you know that over 90% of options traders lose money? Shocking, isn't it? But it's not just about bad luck. It's about the deadly mistakes that many beginners make, mistakes that can turn dreams into nightmares overnight. From the seductive allure of leverage to the silent decay of time, the options market is fraught with pitfalls that ensnare the unwary. But fear not, we're diving into the 15 deadly mistakes beginner options traders make and, more importantly, how you can avoid them. Whether it's ignoring the basics, underestimating the psychological battle, or forgetting to plan for the taxman, we've got you covered. With each chapter, we'll arm you with the knowledge to navigate the treacherous waters of options trading. So, if you're ready to turn the odds in your favor and learn the secrets that separate the successful few from the struggling masses, buckle up. You're about to embark on an eye-opening journey that could redefine your trading strategy and potentially safeguard your financial future. Chapter 1. Ignoring the basics. Have you ever jumped into a pool without checking if there's water in it? That's what diving into options trading without grasping the basics feels like. Options trading isn't just buying and selling, it's an art and science, involving strategies like calls, puts, and spreads. Imagine options as keys to a treasure chest, but instead of gold, there's a mix of opportunities and risks. The strike price? That's your treasure map. And the expiration date? That's how long you have to find the treasure. Not knowing these basics is like searching for treasure in the dark. So, before you embark on this adventure, make sure you understand the terrain. Chapter 2. Neglecting paper trading. Picture this. A pilot without flight simulation training taking off for the first time. Sounds risky, right? That's what skipping paper trading in options is like. Paper trading is your simulation. It's where mistakes are free, and the lessons are invaluable. It's not just about winning or losing trades, it's about experiencing the market's ups and downs without the financial heartache. Think of it as a rehearsal dinner before the big wedding day. You wouldn't want to serve a dish you've never cooked before, would you? The same goes for trading. Practice makes perfect, and perfection in trading means maximizing profits while minimizing losses. Chapter 3. Overlooking transaction costs. Did you know that ignoring transaction costs in options trading is like leaking money? Each trade has a price tag, commissions, spreads, and fees. They might seem small, but they add up, eating into your profits like a termite to wood. Imagine you're on a road trip. Every toll booth takes a little of your travel fund. In trading, these costs can turn a profitable strategy into a losing one over time. It's crucial to account for them in your trading plan. Think of it as budgeting for your road trip, making sure you have enough for both the journey and the tolls. Chapter 4. Misunderstanding leverage. Imagine borrowing a giant slingshot to launch your investment much farther than you could on your own. That's leverage in options trading. It sounds exciting, right? But there's a catch. Just as a slingshot can send things much further, it can also backfire if not handled correctly. Leverage allows traders to control large positions with a relatively small amount of capital. However, just as it can amplify profits, it can also magnify losses. Think of it as using a powerful sports car without knowing how to control the speed. The key is to understand and respect the power of leverage, using it wisely rather than recklessly. Chapter 5. Failing to manage risk. Imagine you're a tightrope walker, balancing high above the ground. In options trading, not managing your risk is like walking that tightrope without a safety net. Exciting? Maybe. Wise? Not at all. Risk management is your safety net. It involves setting limits on how much you're willing to lose, diversifying your trades, and not putting all your eggs in one basket. Think of it as planning an outdoor event. You wouldn't plan it without a backup plan for bad weather, right? Similarly, in trading, always have a plan to protect yourself against market downturns and unexpected events. Chapter 6. Getting caught in the time trap. Time is a sneaky thing in options trading. Unlike stocks, options have an expiration date, which means they lose value as they approach this date, a phenomenon known as time decay. Imagine buying a ticket to a concert that happens only once. As the concert date approaches, the ticket's value changes. If you can't attend, selling it last minute might not get you the best price. In options trading, being aware of time decay and how it affects your positions is crucial. It's like planning to sell your concert ticket, timing matters. You wouldn't wait until the last minute, would you? Understanding and strategizing around time decay can help avoid the trap and potentially save your investments from dwindling away. Chapter 7. Chasing losses. Chasing losses in options trading is like trying to catch a falling knife. It's risky and can lead to even bigger losses. Imagine you're on a losing streak, and in a bid to recover your losses, you start making more and more trades, each time hoping, this one will be the winner. But this approach is like trying to sprint on a slippery slope. The faster you go, the harder you can fall. Successful traders know when to cut their losses and step back, rather than doubling down on a bad hand. It's crucial to have a clear exit strategy and not let emotions drive your trading decisions. Remember, the market has no obligation to move in the direction you want, just because you want to recover your losses. Chapter 8. Relying on single strategies. Using just one strategy for all options trading is like using a hammer for every home repair job. Sure, a hammer is useful, but it won't help much with a leaky faucet. Options trading is dynamic, and markets are constantly changing. A strategy that works in a bull market might not work in a bear market. Successful traders have a toolbox of strategies and know which tool to use in different market conditions. They're like chefs, adapting their recipes based on the ingredients, market conditions, they have on hand. Diversifying your strategy can help manage risk and increase the chance of success over time. Chapter 9. Ignoring volatility. Volatility in the options market is like the weather, unpredictable and can change your plans in an instant. Ignoring volatility is like planning a picnic without checking the weather forecast. You might end up soaked. Volatility affects options prices significantly. High volatility can lead to higher premiums, which is great if you're selling options, but not so much if you're buying. Understanding and using volatility to your advantage can be a game changer. It's about being prepared with an umbrella if it looks like rain, rather than being caught off guard. Smart traders monitor volatility and adjust their strategies accordingly, ensuring they're not left out in the storm. Chapter 10. Neglecting to plan exit strategies. Going into a trade without an exit plan is like entering a maze without an exit map. You might find some interesting paths, but chances are, you'll end up lost. In options trading, knowing when and how to exit is as crucial as the entry. Whether it's taking profits or cutting losses, a clear exit strategy can help you make decisions objectively, without the cloud of emotion. Think of it as planning your route on a road trip. You wouldn't just start driving without knowing your stops, would you? By planning your exit, you avoid the panic of making split-second decisions and ensure your trading journey is smooth and less stressful. Chapter 11. Overtrading. Overtrading is the trading equivalent of binge eating. It feels good in the moment but can lead to regret later. It's tempting to jump into every trade opportunity, especially when you're eager to make a profit or recover losses. However, just like eating, trading is best done in moderation. Overtrading can deplete your capital through fees and can also mean you're not giving each trade the attention it deserves. Imagine you're at a buffet. You wouldn't pile every dish on your plate, right? You'd choose what you really want. Apply the same principle to trading. Be selective, focusing on quality over quantity. This approach not only conserves your capital but also allows you to make more thought-out, and potentially profitable, trades. Chapter 12. Underestimating psychological factors. Trading is not just about numbers and strategies, it's also a mental game. Underestimating the impact of psychological factors is like ignoring the role of wind in sailing. Fear, greed, and hope can push you off course, just like a strong wind. The fear of missing out, FOMO, can lead to jumping into unwise trades, while greed can prevent you from taking profits at the right time. Successful traders are those who can maintain a clear head, managing their emotions rather than letting their emotions manage them. Think of it as maintaining your balance in a high wind. By being aware of these psychological factors and developing strategies to combat them, you can stay on course and navigate the trading seas more effectively. Chapter 13. Ignoring tax implications. Trading options without considering the tax implications is like enjoying a feast without thinking about the bill that comes afterwards. It's easy to get caught up in the excitement of profits, but remember, the taxman cometh. Different trading activities can have various tax consequences, and not planning for these can eat into your returns. Think of it as planning your income and expenses. Just as you budget for rent, groceries, and savings, you should also set aside a portion for taxes. By understanding the tax rules that apply to options trading, you can make more informed decisions and avoid a nasty surprise come tax season. Chapter 14. Lack of diversification. Putting all your capital into a few options trades is akin to betting everything on a single horse. Diversification is your hedge against uncertainty. In the world of investing, not all days are sunny. Some trades will win, and some will lose. By spreading your investments across different assets and strategies, you reduce the risk of a single event wiping out your portfolio. Imagine it as a garden. If you plant only one type of flower and a disease strikes, you risk losing everything. But if you have a variety of plants, some may thrive while others falter, ensuring your garden's overall health. Diversification in trading works the same way, providing a buffer against market volatility. Chapter 15. Skipping continuous education. The market is a never-ending classroom, and traders who stop learning are like students who skip classes. They fall behind. Options trading is dynamic, with new strategies, tools, and market conditions emerging all the time. Staying informed and continuously educating yourself is crucial. It's not just about keeping up, it's about staying ahead. Whether it's reading the latest financial news, taking courses, or participating in trading forums, every bit of knowledge can give you an edge. Think of it as sharpening your tools. Just as a gardener regularly sharpens their tools to ensure the best cut, a trader must sharpen their mind to make the best trades.